Good morning, good afternoon, good evening, everyone. And thank you for joining us wherever you are in the world as you watch this broadcast today. Welcome to our webinar titled Accelerating Time to Value. That means scaling market data for alpha generation and execution analytics. I'm Matthew DeYoung, Senior Product Manager at Market Data at Barchart, and I'll be serving as our facilitator on today's discussion. Allow me to do a brief introduction as we start this webinar. I'll provide a quick context for our chat and then invite our panelists into the conversation. Joining me are two experts from the market data industry who you'll meet momentarily, Mark Water, Global Head of Sales at Barchart, and Gavin Carey, Head of Content at BMLL Technologies. Today's session is intentionally designed to be a little different than traditional webinars. This is not a product demo. It's not a sales presentation necessarily, and it's not meant to be a discussion of any single vendor platform. Instead, I could say what we want to do is have a peer level conversation. We'll just focus on the important challenges that we're seeing across the financial industry. Over the last several years, the conversation around market data infrastructure has evolved a lot. Historically, firms have been focused on one primary question, which is, can we get the data? Today, that's not much of an issue for most firms. Market data is decently accessible, but the challenge has shifted towards three questions. Can we scale it? Can we trust it? And can we integrate market data? And ultimately, financial firms are asking this key question, and we want to address it today. Can we operationalize market data quickly enough to create an advantage? Meaning quant trading firms are being asked to move faster, faster hypothesis, backtesting deployment, and execution analytics. Research teams, as you know, have their own challenges. They're now also expected to work across multiple venues, multiple asset classes, deeper historical archives, and increasingly diverse data sets. So what this means is throughout today's discussion, we'll explore several themes that continue to surface across institutional firms, and you're seeing them on your screen right now. Coverage, scalability, and data governance. One of the reasons that we're excited about today's collaboration between Barchart and BMLL is the two organizations actually approach market data from a highly complementary perspective. BMLL brings deep expertise in market microstructure data, and Barchart brings broad historical market coverage across asset classes. So today's discussion is really about the intersection of high quality data and scalable workflows. Our goal for the next 25 minutes is to keep this practical, keep it conversational, and experience driven. So we'll leave time at the end of today's session for Q&A from the audience as well. And with that, Mark, Gavin, thank you so much for joining us today. And before we dive into the discussion itself, I'd love to just spend a few minutes. You guys could help the audience better understand your backgrounds and your perspective that each of your firms bring. So Mark, we'll start with you. Can you just give the audience attending today a brief introduction about yourself and Barchart?
Yeah, so my name is Mark Water, Global Head of Sales here at Barchart. Been with Barchart coming up on 20 years at this point, and we're a 30-year-old company that is a multi-asset class data vendor. So it's futures, forex, equities, cryptocurrencies, mutual funds, cash, physical, fundamental, economic data, a little bit of everything. And where we really begin to shine and where our specialty is bringing that all in, normalizing it, and then providing access to quickly ingest long tail history. And that, I think that would pretty much sum up Barcha as a whole.
Perfect. And Gavin, I'd love for you to do the same. Just can you give a brief introduction about yourself and about BMLL technologies as well?
Perfect. Thanks, Matt. So hi, everybody. I am Gavin Carey, and I'm the head of content here at BMLL. I've been with the firm for a little over a year now, but I've been in the financial market data industry for a little over 25 years. During that time, I've run technology, product, and business teams for some of the largest firms in this space. BMLL are the leading independent provider of harmonized level 3, 2, and 1 historical data analytics. Some of the world's most sophisticated capital markets participants cover global equities, ETFs, futures, and US equity options. Pleased to be here.
Yeah, thank you. Excellent. Thank you, Mark. Thank you, Gavin. And I think that framing that you mentioned is a perfect setup for the broader discussion that we want to have today. So with that context in mind, let's dive right in. Let's jump into our first discussion question. Gavin and Mark, where do firms often struggle after they've solved getting access to market data? What would you say to that question?
Sure, shall I hop in first? So I think access is probably the easy part. The hard part is everything then between going from that raw data feed and a researcher being able to ask a question and get an answer of the data. So we have schema differences between venues, we have exchange enumeration differences, we have reference data alignment problems, we have corporate actions data that we need to take into account for, and of course timestamp regimes that don't necessarily line up across all of the venues. That, I think, is where all the engineering time disappears. I've had conversations with teams that have spent maybe 18 months getting data in the door and wrestling with that data. And at that point, they're still 6 months away from having a research-ready data set that they trust.
Yeah,
I guess, sorry, go on, Mark, go ahead.
no, I'd say Gavin, because what you're describing is something that I think Matt and I, if anyone's actually seen webinars we've done previously or the videos we put on LinkedIn, Matt and I describe as our iceberg. It's, the cost of acquiring the data is just part of the cost. But the real cost is the maintenance costs, the hidden costs that are ongoing costs year to year of maintaining that data architecture that you kind of cobbled together over time. All of those things that you're talking about have a cost. There's an opportunity cost. There's a real physical cost to it. That does not disappear. You look at it as you're going to spend this much money obtaining market data, but you then have the cost of engineering, the cost to be able to back test, the cost to maintain, and that's the hidden cost over time that firms are going to struggle with because they don't bake that into the equation when they go to acquire market data.
Yeah, absolutely.
I think that brings up the next question, Mark and Gavin, which is what is the underestimated or what is underestimated most? Is it really acquiring the data or is it making it research ready, as we just mentioned?
Do you want to hop in first, Mark? Or?
Actually, Gavin, it's, you could take a run at this one.
Cool, perfect. So I think for me, it's, if it's an either or question, then it's making it research ready, right? Every time, it's not even close. Acquisition's a procurement exercise. They're painful, right? No one enjoys sitting and wading through contracts, but it's a known activity. It's time bounded. When you move on from that, though, getting to research readiness is much more open-ended. You've got, as I said in that last question, to harmonize those schemas, to reconcile all those corporate actions, align the timestamps, validate the completeness. And I think the real trap is you think, well, I've done all of this stuff, right? Or I'm doing all of this stuff. This feels quite tractable. I'm going to start to make commitments to build on this data. And then when you do, well, that last 20% rears its ugly head. The edge cases, the inconsistencies in the data over those extended time frames, venue-specific quirks, the regression testing that you need to do every time an exchange changes a field or a vendor misuses a field for the sake of their real-time alacrity. That's what eats up all the time, and it never finishes because venues keep changing their feeds. I think you often quote. Go ahead, go on.
No, it's because I was going to say it's the other side of that though, Gavin, is what happens when you get that wrong.
Yeah,
those are all the things that you have to do, and each one of those introduces another point of failure. If you get one of those things wrong, if you miss one of those steps, if one of those data points goes bad, you've now lost not just the time, but the output is going to be incorrect also. So it's as you continue to talk about all of these things that we have to do, every single one of those is an operational point of failure in your data chain of custody until you can generate your trade ID. And is that what you see on your side?
Yeah, absolutely. What do we hear? We hear commonly, I think it's an often quoted statistic in this market, right? That is, researchers are spending 80% of their time sourcing data, cleaning data, lining it all up, getting the thing they need, not answering their questions, not generating alpha. That's really the problem all of us in the industry are trying to solve, right?
Totally.
Yeah, so this is a perfect segue to the next question that I want to raise to you both. When does the conversation at any given financial firm switch from can we get the data to can we trust and use the data? Where's that line in the sand?
Yeah, trust is an interesting word to me because it starts to peel back in layers. Because if you're stitching together multiple data sets and you have multiple data inputs across a whole organization, which one do you trust? And how do you establish which one you should be trusting? So you can have multiple trade desks having multiple different data sources for the same exchange, the same data point. And then it becomes a matter of, okay, we're comparing these three. We're getting different outputs from all three. Okay, are these server timestamps? Are they exchange timestamps? How is this compiled? Oh, we're using a minute bar. Well, how is the minute bar built? Because there's no standard for that. It's open, high, low, close volume across a 1 minute period. Okay, that sounds simple, except when does a minute start? These are all questions that you have to begin to ask. So how do you trust a source? How do you determine a single source that can be trusted? And unless you're really normalizing and bringing it all in from a single source across a single schema, I don't see how you can determine who is the sole source of truth at one point.
That's really good. Yeah, I mean, for me, I think was the question about when does the conversation shift from can we get the data to can we trust it? Usually for me, I think we see that about the second time that a backtest result surprises the engineering teams, tells them something they can't explain. So the first time that happens, they'll go, oh, must be my model. We must have done something wrong. And the second time, they start to look at the data more closely, trigger that audit. And that's the moment that conversation flips around. Mature teams that we've worked with in the industry try to move that moment to the left. They come into the conversation assuming that trust needs to be demonstrated by the data, not assumed by their engineers. They need to see that lineage. They need to see completeness metrics, perhaps. They need to see that the reproducibility that they need to achieve has been built in from day one, not retrofitted when the model's blown up, when they've made their learnings painfully and expensively. It's a really meaningful behavioral shift, right? And I think we're seeing that accelerate in the last couple of years, and hopefully we think we've helped drive that acceleration.
Yeah, but I can tell you have firsthand experience because sometimes you mention things that feel like you're reading from our diary, like, oh, how did you know we faced those issues? So they're very, very, very common. I mean, Gavin, another question I'd have for you is this next one I want to put on my screen here. What challenges arise when liquidity is fragmented across different venues or even geographical regions? How would you answer that?
I think there are probably three challenges. Let's try and take them in the order that and the amount of pain they cause people. The first one, I think, is probably you can't really reason about best execution or liquidity unless every venue you've got is presented in the same format, in the same schema, with the same levels of rigor and assertion attached to them. The European markets are a really good example of this. So you might have a single instrument trading on the primary market, maybe 2 or 3 MTFs, a couple of periodic auction venues, a handful of systematic internalizers are going to be reporting data as well. And as a data recipient, you might be taking data from all of those locations, each in their own formats, each with different trade condition codes, and so on and so on. So you're going to spend more time looking at that data, analyzing it, normalizing it, than you're going to have generating value out of it. So what do? We attempt to harmonize that data into a single lossless format that still preserves all of the fidelity, all of the information in the market data feeds, but brings it together in a consistent way that you can then use to do that cross-venue analysis without losing the detail that you'd want when you try and zoom into a single venue. So that's the first one. I promised you 3. Second one, fragmentation can break naive metrics really quickly. So when you look at the top of the book, if you look at the top of the book for the primary market, it doesn't really tell you anything about a stock's liquidity these days. You need to look at a consolidated view, and you need that view to be at the right resolution. Something like a millisecond consolidated best bid and offer across all of the lit venues would let you see where that liquidity actually was at the moment when the parent order arrived to the market, not where it appeared to be if you were just looking at a single market or a subset. Final piece then, and this is probably the one everybody misses, fragmentation also interacts with that market state. Not all venues are open and closed at the same time. They don't all have their auction phases at the same time. They don't all go into a halt at the same time. If your data set doesn't carry market state, then your cross-venue analytics are going to be quietly wrong at exactly the moments that it matters the most for you if you're trying to execute in the market. So the reason firms come to us and talk to us about this conversation is they don't want to rebuild all of that plumbing, they don't want to relearn all of those lessons for every new venue and every new region that they move into. We've done it once, we'll do it properly, and we'll keep doing it as those feeds evolve.
Yeah, Gavin, those are all good points. And like I said, born from experience and highlights something that we're all considering, which is on which side of the fence should all this consistency and normalization sit? And what is our real purpose? Is it dealing with plumbing, or is it something else, something that our firm would consider more important? Mark, another question that I want to bring up, if you could address this, is how important is historical continuity when validating, say, a trading or hedging or portfolio strategy?
To me, historical continuity is paramount to being able to backtest or visualize something. One of my favorite ones is we have a lot of clients that do vol surface visualization, like 3D visualizations of vol surfaces. And nothing quite shows you a problem with historical continuity like a 3D visualization of historical data, because there's a giant black hole sitting right where a data point should be. And it makes it very easy to tell. It's much harder to tell that when you're actually just running a backtest, because you don't just stare at a screen and see that gaping missing part. Rather, it shows up as a bad output. So then you're stuck combing through it, trying to figure out where the data set had an issue, and doing that due diligence ahead of time, being able to test the quality of the data to make sure there is that continuity, as Gavin had mentioned. That is what a mature data management team will do, and be able to know that they can trust the data going in. We kind of talked about that. If you don't take those steps, you're going to lead to problems down the road. And these are things, I mean, it's not just a missing data point, it's making sure the timestamps are the same across everything. It's just not going to be able to flow together if you don't have that continuity and you don't have that normalized schema for all of your inputs.
Mark, Gavin, I know there's some highly qualified, smart folks on this webinar today, and some of this might not be new information. It could be for some folks, but if nothing else, it's a reminder of kind of how to architect our projects going forward. So I thank you for that. Here's a question I'd like for you to both address. This is good for both of you. What downstream problems occur when data sets are incomplete? What do we see there?
I could jump in here. I mean, when data sets are incomplete, the data needs to be rebuilt and it becomes stitched together. And if that's done inaccurately, it'll impact the output. So there's multiple different facets to this also. It's like we just talked about missing data. Missing data is one problem of an incomplete data set. But if it's historical data, incomplete data could be that from a future side, missing expiration dates, not having correct contract specs, not having proper market hours in terms of days that weren't traded, because then you won't know when the data was actually supposed to be there. There's multitudes of things that can feed into what is incomplete data that at the end result is a bad output. And a bad output could be the difference between a trade idea happening and not being able to implement what could be an alpha generating trade idea. And we really need to work to try and create that confidence in the data, where you can just easily, quickly recognize time to value across that chain and take a trade idea to fruition.
Yeah, Gavin, anything you would add there?
Not too much. I think it's spot on. Yeah, we've definitely seen examples in the past of firms who don't have the trust in their data that they need to have, and they will narrow and narrow their search domain until they get to a point they can trust, and that means all of that domain left behind is opportunity that they're never going to be able to trade on. It's a real strategic cost, and it's kind of invisible, right?
Yeah, great point, Gavin. Here's another one I think you could both address. Why are firms increasingly combining sort of market structure data along with, let's say, commodity or equity fundamentals, or even non-exchange data like satellite imagery or weather? Why are they doing that?
I guess from my point of view, the type of data that we get involved with, it's going to be because the questions that matter are increasingly cross-domain. If is this stock cheap is a fundamentals question, then can I get into this position without moving the market is a microstructure question. When we treat those as separate workflows and separate teams and separate data sets and separate tooling, that leaves money on the table all over the place. So the pattern I see most on the buy side is portfolio managers who used to hand a list of names to traders without any real context. Now, before they do that, they want to understand the liquidity profile of the names before they then size their position. Microstructure data changes that from a post-trade TCA conversation into a pre-trade portfolio construction input. It's a trained-in workflow that means that the breadth of data and the depth of the microstructure needs all need to be in the same place, right? All needs to be in a similar tool, ready to engineer on.
Yeah, I
ahead.
love this question because it highlights one of the things that I really enjoy about it is fundamentals mean something different to everyone. Because we see it from a different side of fundamentals, where we see fundamental commodity data. And we have a lot of physical commodity trade houses. We have a lot of quantitative trading firms that are in the multi-structure or multi-asset class domain, global macro funds, so on and so forth, that are combining exchange price data with fundamental data, whether it be FOB prices, whether it be cash prices, whether it be physical prices, to tell a different story. And we're seeing this across a lot of different trade flows. It's no longer just exchange price data that you're back testing on, because that has become table stakes and everyone has it now. With how much we've been able to store data, with the explosion of data storage and scalability of cloud, everyone's getting large data sets. It's what can you combine with that data set to help generate extra alpha. So commodity fundamentals give an interesting approach because you're starting to take what used to be things, the land of the discretionary trader. They knew where to find these little niche data points. They knew where to find something that could give them a leg up over the guy at the desk next to them. And you're taking those data points, you're normalizing them, and then bringing them into quantitative workflows. And that's something that we're seeing happen increasingly over time. And it really then starts to point, though, to that normalization and trust aspect. Because we had someone that was looking at we have a cash grain database. We can tell you what anyone's willing to pay for grain at something like 98% of the elevators across the United States. And they said, that's great. I want to start looking this at the 10 minutes before market close. And we're going to combine the cash market 10 minutes before market close with the actual trading market. And we're going to be going, I think they were going after the corn contract for CBOT. Well, if you don't actually have the correct timestamps and everything's normalized to a server timestamp rather than the timestamp of where it originates, you're not actually getting the 10 minutes before market close. You're getting the 10 minutes to the hour, 2 hours after market close because you're in a different time zone. And that's not what they're actually looking for. So when you start combining all of these fundamentals, you're looking at reporting times and if there are different time zones from the exchange, and you're trying to figure out how to stitch that all together. It's really interesting workflows that we're seeing to kind of build out of this market data, fundamental cash, physical data, marry the two together, and come up with a trade idea that generates more alpha.
It sounds like to me from both of your perspectives, we're really talking about a market intelligence that has context, contextual market intelligence. So that's an important theme for those listening in on the broadcast today. Mark, could you address this question? What new workflows are really emerging out of this sort of multi-data set research? Meaning, is it forcing certain issues? Is it changing our workflows?
Yeah, I guess I should have read your questions earlier because I think I kind of answered that in the last one, but I can explain on it a little bit more. So yeah, I mean, as we start looking at these new workflows, what it really comes down to is time to value. How fast can you go from having an idea to being able to update your trading engine after you've proven the idea works? And for us, we're trying to draw a clear line because keep in mind, the only way this is going to work is if you have a centralized, normalized data source. Because if you don't, time to value breaks down. Because then you're spending time, as we were talking about, stitching everything together, trying to make sure all the data works together, trying to make sure there's continuity, making sure there's no errors in terms of reporting. But if you have good time to value, you could actually go from trade idea to updating the trading engine, generating alpha rather quickly. We see this from our workflow that is heavily put into the quant side at this point. We have a front-end data visualization platform we call Commodity View. Within it sits Carl, which is our friendly AI generative chatbot. And what that is really good at is uncovering additional data points. So you could go in there. I know I used the example recently of someone going after a cash corn contract. You could go in there and type in corn, and what does Barchart have on corn? And it would put up a list of all the different data sources we have. And like I said, it's futures, it's cash, it's physical, it's options. And then you can go, and since you have this centralized normalized database, you can start ingesting that. And it's all sitting there, and you can start back testing it. And you can go from generating the trade idea, back testing the trade idea, and updating the trading engine extremely quickly. And that's time to value. You're able to take inputs that are reacting to current market conditions and identify them, test them, then implement them much faster than you would previously.
Yeah, that's a good point, because firms are being asked to move faster to get to the result much faster. Gavin, could you address this question? Why has mature market data governance become a more critical issue recently?
Yeah, so I think a few things have probably come together in this space over the last little while. There's a lot more regulatory scrutiny, particularly on kind of best execution and model governance generally. Tightened up. Firms really need to demonstrate reproducibility, not just make those claims. We're also now seeing prevalence of AI and machine learning in everything, and they've made those data sets a first-class concern. If you can't tell me where that training data came from, you can't tell me that the model that's trained on it is fit for production. Firms are running more strategies, more data sets, with more people touching them, mean that the blast radius of an uncontrolled or an incorrect data set has really gone up. I think the other shift is probably that governance used to mean the compliance team signed this off. Now it means I can reproduce any number that I've ever reported on demand with full lineage. It's a much higher bar, right? And it needs, I think, four things. It needs lineage for any output. You can trace it back to a specific input. You can tell me the specific transformation that it went through, the specific version of the code that made that change. It needs reproducibility, that you can run a research result from 12 months ago and get that same answer. That sounds obvious, but I think there are very few people that can do that without heroics at the moment. You need to know point in time correctness. If your reference data changes, if you get a new reference data set, your historical view, to make sure that repeatability is available to you, that your historical data needs to not change because the reference data has changed. It needs to stay fixed. And then, of course, there's entitlements, right? Titles need to match a licensing. We need audit trails about who can see what data, who's done what with what data. I think there's a maturity test that I'd ask everyone to consider. If a regulator came and asked you tomorrow to reproduce the TCA results from 2 years ago, how long would it take you? I think a mature firm, so someone who's got all of that in their pocket, probably would answer that question in a couple of hours. For most firms, probably we're answering these questions in weeks, if we're answering it at all.
Yeah, that's good, Gavin. I think that is an excellent answer. I got one or two more questions I want to get to before we wrap the webinar. Mark, would you add any just quick additional point there?
But on my mind, data governance is just two things. There's internal data governance, who has access to data, how quickly can we shut them off if we need to shut them off, who do we know is using the data, but also external to internal data governance. Like you were saying, Gavin, it's if a regulator comes, well, if an exchange comes and says, how are you using this data? How do you know that you are properly licensed? How do you know that your data source is also a good actor in the reporting world, and being sure that you don't have an operational risk there? Because that's the other side. To me, it's internal and it's external, it's traceability. It's being able to say, yes, I'm using this generative AI tool internally. And yes, exchange XYZ, we are producing something that has your market data in it. But as you can see, this AI tool does not have access to my internal market data, but it is still pulling it from the open internet. And therefore, that is not my fault. These are things that will come up. There's conversations being had with how do you trace data in AI? Mature data governance would be able to say, that's not coming from me.
Yeah, it's a really critical point. That's why I love doing these webinars is maybe somebody today that was a highlight, the answer you both gave. You go, I have some things to think about. I have some things to check on. A couple more questions, just really briefly, and then we're going to wrap the webinar. What signals do each of you think, Gavin, Mark, that start to indicate a firm has outgrown its internal approach to infrastructure for market data?
I think I've got 5 signals. Most firms will probably hit a few of them, maybe all at once, before they really admit to themselves that they've got an issue, that they've outgrown their current approach. So signal number 1, I think, is your data engineering team is bigger than your research team. That's probably the clearest sign that your infrastructure has become your product. Number 2, if you measure onboarding of a new venue in quarters rather than weeks, then that's a real problem, right? A market opportunity shouldn't be gated by a 6-month engineering project. Number 3, researchers are probably sitting on their own secret data set, quietly maintaining their own copies of data that they've learned to trust. If you see that happening, you've already lost reproducibility, the thing we talked about in that governance section, even if nobody said so out loud. Number 4, your TCA numbers and your live trading numbers can't be reconciled. Nobody can tell you why that's the case. Well, then you've got a data lineage and a data governance problem, dressed up as a data problem, but really it's governance. And then 5, if someone comes and asks you, can we run this analysis across our markets? If your answer is, let me check which ones we've harmonized, which ones we've normalized, well, then again, you've got a real issue, right? If you've ticked maybe, I don't know, got 2, 3 of those, then you've probably already outgrown your current model. And the question is, how much is it going to cost you to carry on?
Yeah, that's good, Gavin. I mean, I say it's good, but it's concerning because I feel like you've read our journal and you know exactly what's happening inside of a project or firm. Mark, would you add anything to that?
Yeah, so I like how Gavin has 5 signals because we actually have a 5-signal diagnostic because what Gavin was saying is we tried to quantify for people. We tried to give them a tool that they could actually look over and say, we know that there's an actual cost tied to all of these hidden costs of maintaining data plumb. And what we tried to do was create a diagnostic where you could go down a list and say, okay, this is a little bit present, this is very present, this is strongly present for us, this is moderately present, and be able to actually look at it and begin to quantify how much time, how much opportunity costs we have, how much actual physical dollar spend we are burning on maintaining an old infrastructure. So, I mean, for some firms, that could be up to 7 figures a year. These are not small costs. So for us, it's using the tools we've developed that we share to just get people to start thinking about and understanding where their market data infrastructure is, and is it something that has become a liability rather than an asset in terms of time to value.
I mean, I think that's a great answer. I don't know if I need to show this on my screen to say what are the next steps, because I feel like you might have started to trend in that direction already. I mean, Mark, Gavin, would you guys agree the answer to the question is starting to appear already? What separates firms that are quickly moving, ingesting market data, getting that contextual market data intelligence versus the ones that are really getting stuck right now? What's the separation? What's the difference?
I mean, to me, it comes down to just one simple thing: a trade idea that is implemented versus a trade idea that can never happen. And it's that very simple statement that says, can we take something that we've identified and actually implement it? Or are we going to hit so many blockers down the way that we are never going to get to generate the alpha off of what should be a good trade idea?
Yeah, I think that's really important, Mark. We'd term that kind of time to insight, or I guess you'd say time to value. So we've got a thing called Data Lab or BMLL Data Lab. Customers using that tell us that they see a huge reduction, maybe up to 95% in time to insight versus their on-premise infrastructure. And so what we're really seeing, I think, is the folks that can go fast in this space are not treating their market data infrastructure as a secret source thing, right? It needs to become a utility for them and not a differentiator, so they can spend their time and their money on the research and the trading decisions. So they buy the plumbing, they govern it really well, and they put their best people on answering those questions, on generating alpha.
Yeah, it's a good point, guys. The conversation about build versus buy, it's always been there, but now it's kind of changed, and we're really having to take a hard look at what is truly beneficial when it comes to financial firms. Let's talk, Mark and Gavin, about what are the next steps as we begin to wind down the session. What practical next steps would you recommend to the audience listening today?
I can't go with audit your time to insight, and Mark talked really eloquently about the kind of tools that are available out there to help you do those things. If you're spending more than half your time in engineering, you've got a structural problem, you should really spend some time and effort fixing it. Pick a workflow, right? Pick something that you know you've got a known blocker in your existing pipelines, and try something new. A trial on a real workflow is going to be worth so much more to you over a couple of weeks than you'd get out of a normal 6-month vendor valuation period. And then be honest with yourselves. What should you be building and what shouldn't you be building? The infrastructure you need is there, right? It's genuinely available now. The firms that admit that to themselves are going to go faster. They're going to win.
Yeah, that's good, Gavin. Anything you would add, Mark?
Yeah, we kind of mentioned it earlier. I'd point us towards that 5-signal diagnostic. Begin to take a look internally and see and self-identify where you could grow. And when you decide that it's time to address these issues, reach out to BMLL, reach out to Barchart. I think we're both going to be at FIA IDX coming up shortly. So meet us both together in person and figure out if there's a way that we can help you guys kind of address some of these issues. But the first step is looking inside, like Gavin said, looking inside, testing something and seeing, do we actually have a chance for improvement? Don't focus it on it just being a problem. See if we could actually speed something up. See if you can reduce costs and generate more returns with such a simple move as addressing your market data plumbing.
Yeah, thank you, guys. We're both talking about the same theme. So Barchart just went a little extra way here and put together that 5-signal diagnostic. If you'd like to receive this, it really is just for you to help out and assess your own firm where you stand. Gavin, you outlined some of the signals, but how do you assess those? So we put this in this little PDF. We can deliver it to you after the webinar. If you want this, what would help is if you just enter the word 5 in the GoToWebinar control panel chat box, just FIVE, those letters, into the GoToWebinar control panel chat box. That way we know who to deliver this PDF to. Do this before we close the session. With that, let me just say this has been great. We've covered a lot of ground today. Before we wrap up, I'd like to spend just a few minutes addressing any questions from the audience. We received several great questions already, so I'll do my best to direct them to the right panelist. With that, let's transition to audience Q&A. If you have questions, go ahead and post them to the GoToWebinar control panel question box right now, please. And then rest assured, if we don't have time to address every single one live, our teams will follow up shortly after the webinar. The first thing, question I think that kind of comes in, I wanted to address, it came in various different forms, but I'll summarize it like this. How will the data aggregation process handle this shift in the markets towards 24 hours? Perhaps new fragmentation gaps appear. I know this is a little bit of a new frontier, so I'm not sure if we have all the answers worked out yet, but any comment on that from either Gavin or Mark?
I think it'd be interesting. I definitely don't think all the answers exist yet. I think it'd be really interesting to see how the market reacts to those sessions. Are we going to start considering everything as one big session, or are people really going to focus on a day and a night session? When are they going to want to prime in their systems with different, not quite closing values, right, but maybe an end of session value or whatever it might be? I think there's a lot of interest to me in how does that shape up over time, and how do people chase things around the globe, right? There are indices at the moment that value moves around the globe. Will that change? Will they suddenly centralize in a particular location, or will they will the money continue to circle? There's a whole bunch of interesting things there for me.
Yeah, it's, like Gavin, like you said, we're not going to have the answer because at one point the market will dictate the answer. But the other side of it is being a multi-asset class data vendor. This isn't the first time we've seen this. We cover Forex, we cover cryptocurrency. We're used to a 24-hour market in those regards. And we've set up a framework to handle a 24-hour market. For us, it's more seen, will the market, as we move to 24 hours in other venues, will it act the same way? And can the structure we built hold true to it? Or will we have to adapt a little bit from those other 24-hour markets we currently serve? So for us, we're going to accept it, but we are also going to have to learn from the market, really.
Yeah, I think it's a really good point. I think the prediction markets are a hobby of mine at the moment, I guess, within BMLL. And much like the crypto markets, right? You see the kind of volumes trading are really interesting. The shapes are so different to what you would expect to see on a normal market because of what people are taking positions on, right? Whether it's a sports game or whatever it might be. It makes for a really interesting data set to manipulate and play with.
Yeah, Gavin, remind me to sit down with you at one point, and we won't do this as part of the webinar, but I'm really interested to figure out how we're going to assign symbols to the prediction markets when they say the next pitch is going to be a ball or a strike or something. Because that only exists for 30 seconds. So let's just talk about that one off camera, because I'd really love to chat with you about that.
Perfect, yeah.
Well, guys, it does bring up a major theme as we kind of close out the webinar. There's other questions out there. They tend to be a little bit specific, not so much for the general audience. We can follow up with those after the webinar. But there's a big theme here, which is, where does the normalization layer sit? Who's working on that? Is that make sense to be on, on a market data vendor side or elsewhere? I think it's worth assessing. And so it does segue nicely as we wrap up the webinar today. I want to say, excellent questions, everyone. Mark, Gavin, thank you so much for joining and sharing your perspectives. Everyone who attended, we want to thank you for spending time with us today. As a next step, we do encourage you to request our 5-signal diagnostic guide. The purpose of that diagnostic is really just to help anybody who's on the webinar today evaluate right there in their firm where research friction may be, where it might exist across your current market data workflows, and whether that involves maybe coverage gaps like we mentioned today, integration challenges, it might be historical continuity, data governance like we mentioned, or maybe it's just about finding ways to reduce operational overhead associated with that market data infrastructure if you're managing that internally. So the guide's designed to really just help you better understand if there's any kind of hidden bottlenecks that might slow your time to value, your research velocity, delayed analytical insights, and so on. So our plan is to send out a replay from today's webinar, so you can expect that. And once again, if you want to receive the 5-signal diagnostic, enter the word 5 into the GoToWebinar control panel chat box. That's FIVE, and then we can know who to send out this PDF 5-signal diagnostic to. Thank you so much for joining us again here on the webinar today. And on behalf of Barchart and BMLL Technologies, we really do appreciate your time and hope everyone has a great rest of your day. Bye for now, everyone. Cheers.